Hi, we're finishing up chapter 3 on this video. We've been talking about the adjusting entries and the accruals and deferrals that need to be done at the end of the month so that our accounting will be correct. We'll have all of the necessary expenses and revenues in our journals and our ledgers, and we'll have the right balance on our accounts. It's an important process. So once we figure out what entries need to be done and we put them on the books, there's another thing we need to do. We need to make sure that we balance. So that's what we're going to do. We're going to talk about the adjusted trial balance next. All right, so you already did trial balance. At the end of chapter 2, we did trial balance, and it was in order to try our balances, right? We had been doing our transactions all month long. We analyzed them, we journalized them, we posted them to the ledger, and we used T accounts to pretend we were posting to ledgers. And then we listed all the accounts in a specific order: the assets from most liquid to least liquid, the liabilities from current to long term, the equity accounts, revenues, expenses. So we listed all our accounts, and then we put their balance in either the debit or the credit column, depending on what their normal balance was. And we looked at the bottom to see, did the debits total equal the credits total? And that was our trial balance. And that's great. We always do that before we do the adjusting entries. We do an unadjusted trial balance. So that way we're not starting out doing our adjusting entries when we don't even balance to begin with. But once we do our adjusting entries, well, now we've added some transactions to the books. So we better check again and make sure we did those adjusting entries right. So we check and see through an adjusted trial balance to make sure we got those entries right and our debits still equal our credits. So that's what we're doing. All right, so the adjusted trial balance includes all of the adjusting journal entries associated with deferred expenses, deferred revenues, accrued expenses, and accrued revenues. The purpose of the adjusted trial balance is to ensure the debits and credits are equal. Even if the debits are equal to the credits, there could still be some errors in the journalizing or posting process. The adjusted trial balance is used to create the financial statements prior to the closing process. So next chapter, we're going to talk about the financial statements and closing the temporary accounts. But for now, let's stick with our trial balance. So here's what's happened. We had a month that went by, and as the month went along, things happened, and we journalized and posted those transactions. At the end of the month, we sat down and we did a trial balance to make sure we still balance. Then we said, oh, let's see, well, are there any other things that we need to get on there? Are there any accruals, any deferrals? And we did our adjusting entries. So the thing about adjusting entries is they're just another kind of transaction, so they need to get in the ledgers, right? So we have to journalize the adjusting entries, we have to post the adjusting entries, and then once we've posted them, we go ahead and prepare an adjusted trial balance, just like when we did our trial balance at the end of the month before. All right, so that's all this is. It's just to make sure we're still in balance. All right. So here's an example of an adjusted trial balance. It looks like the trial balance, doesn't it? So the unadjusted trial balance, we did some adjusting entries, now we're doing an adjusted trial balance. If you look at this example, you'll see that the adjusted trial balance includes the balances after they're posted. So again, all your accounts in their specific order they go in. The accounts that are debits normal debits are in the debit column. The normal credits are in the credit column. And you'll see my debits equal my credits here. The debits are equal to the credit in the unadjusted trial balance, which is similar to the unadjusted trial balance discussed in Chapter 2. The information from the adjusted trial balance is used to create the financial statements in the following order: income statement, statement of retained earnings, and the balance sheet. So we're going to take this information, because now these are the corrected balances, right? We did our adjustments. So we're going to take this information to make those financial statements. Now I do want to talk for a minute about the impact of adjusting entries, because we have to do them. They're really important. Why? If we don't, our financial statements will be wrong. Because remember, this back here, the adjusted trial balance is what we're going to use to prepare the financial statements. This has our adjusting entries included. If we just use our trial balance, we wouldn't have those adjusting entries, and we would have inaccurate financial statements. For example, if the adjustment for a deferred expense is not made, the asset account will be overstated and the expense account understated. This type of error results in an overstatement of net income because the expenses are too low. A summary of the impact on the financial statements is shown in Exhibit 3.6 on the next slide. So think about this. If I forgot to do the adjusting entry for the prepaid rent, right? So remember, prepaid rent had that original entry, right, for the prepaid rent. So we had, say, I think it was $3,000 worth of prepaid rent on the books, and we reduced 1,000 of it by taking rent expense. Well, if that didn't happen, if we forgot to do that adjusting entry, we would still have the prepaid rent as an asset. So that asset prepaid rent would be $1,000 overstated. It would be too high. And we didn't put the expense on, so we would have too few expenses. Our expenses would be understated, right? Too low. If your expenses are too low, your net income will be too high or overstated, right? Because how do we get net income? Net income's revenue minus expenses. So if our expenses are too low, then our net income is going to be too high. So this Exhibit 3-6 from your book, you might want to look at there. It's showing how important the adjusting entries are. So it shows if you forget a deferred expense, if you forget a deferred revenue, if you forget an accrued expense, if you forget an accrued revenue, you are forgetting the adjusting entry. Therefore, two financial statements are going to be messed up: the income statement and the balance sheet. So it's really important, right? If you forget that deferred expense, like I just talked about, income statement, expenses are understated, therefore net income's overstated, assets overstated, equity overstated. If you forget to put a revenue on the books, right? In other words, we had that unearned revenue on there, so we have a liability that's still sitting out there we never took off. We have a revenue we didn't get to claim, so our revenues are understated, our income's understated, our liabilities overstated. We say we still owe that unearned revenue when really we don't, and our equity's understated. Accrued expenses. So if we just forget about an accrual, right, you can see it could be easy to do, like, oh yeah, we had that loan at the bank, it must have accrued some interest. Now you would see it on a bank statement and things, and people have standard entries so they remember to go do them, but you can see it could happen. You could forget to do an accrued expense. So if you forget that, then you don't have that expense and you don't have that liability, so your expenses are understated. When expenses are understated, net income is overstated, and we wouldn't have that payable put on there. We wouldn't have that interest payable or salaries payable, and so therefore our liabilities would look too low. So our balance sheet's wrong. Accrued revenues. If we did some work and we forgot to put it on our books, that would be terrible. We would have that asset receivable not on the books. We'd have our revenue not on the books, so our income would be understated. It would just be a big drag. The adjusting journal entries are absolutely necessary to the financial accounting and reporting process. Without them, many accounts will be understated and others will be overstated. For example, If we fail to record accrued revenues, both the assets and the revenues, and subsequently the net income, will be understated. Or if we fail to record depreciation expense during the period, assets will be overstated while expenses will be understated, i.e. too low, thereby resulting in an overstatement of net income. All right, we are going to talk about worksheets next. So, you may remember we talked about that Excel assignment in lab class the other night. So you've seen a worksheet, you've seen an example. Maybe after this video you might want to go look at the Excel assignment and open up that worksheet so you can see it for yourself up close and personal. It's interesting. So obviously out in the real world, to prepare a trial balance, prepare the income statement, we need to figure that stuff out. So we do it on Excel, right, or some other accounting software. So a worksheet is a useful tool to aid in preparing the adjusted trial balance. The worksheet provides columns for the unadjusted trial balance, the adjusting entries, and the adjusted trial balance. The worksheet is an internal document and is often prepared in Microsoft Excel. So internal document, that means outside people aren't going to look at it, right? So the financial statements, right, investors, bankers, people like that look at it. That's why we have to prepare them in specific certain ways with specific certain accounts, right? But an internal document, we prepare however we like. So we do it in Microsoft Excel and we create our columns, and nobody's going to look at that from the outside. So let's look at an example of a worksheet. So you may want to look at it in your book, or you may even want to open that worksheet we're going to use for the Excel assignment, the one for Javelina Corp. So we have a worksheet, and this is an example. It's from page 142 in your book, 3.7. So this is a partially completed worksheet. So we're going to really get into worksheets in detail in chapter 4, but you want to start thinking about them, start making sure you know how to use that Excel. So start thinking now. That Excel project's not due till November, but you don't want to wait till like November 6th and find out you're not very good at using Excel. So get on it now, open one up. So this is kind of the thing we're going to do. If you look, you see the accounts are listed just like a trial balance. All the accounts are listed. You'll see for each section we're going to do, there's a debit and a credit column. So there's the unadjusted trial balance, there's the adjusting entries, there's the adjusted trial balance, then there's income statement and balance sheet columns that we're not going to really use yet. But I think you can kind of see how this helps us make sure our debits are equaling our credits for our trial balances. Right? So we do our unadjusted trial balance first. Then we sit down and think about what entries are important, what accruals and deferrals do we have that need to get on the books, right? So what prepaid asset did I use up? I need to expense. That's a deferred expense. What assets do I need to depreciate and to accumulate depreciation and get depreciation expense? What revenues have I earned and now I can take off the books because take off that liability because that unearned revenue I no longer owe. I did the work to deserve it. Those are deferrals. Maybe there were some accruals. Oh, this employee's worked, we're going to have to pay him. We're not paying him this month, we're paying him next month, but we owe it to him. We better put that payable and recognize that expense. Same thing with revenues. We did some work. They haven't paid us cash, but we have that receivable and we get to recognize that revenue. So we figure out what entries need to be made. That's the adjustment column. We figure out what entries should be made, and there's always that debit and that credit. So the debit goes in the debit column, the credit goes in the credit column. If you look at this worksheet closely, you'll see that for the adjusting entries, there's little letters next to them. And that's just so you can match them up. So you can see that for, it's too small for me to read. So that for that first account receivable debit of $800 with designated H next to it, well, you can look over in the credit column and find the H, and you'll see that that was service revenue. It's part of that 1,000 down there. So just let you match up the debit and credit portion if that's something you want to do. But that's a worksheet. So then once you've done the trial balance, you put your adjusting entries in, then you're ready to bring that over and make a new balance. So every one of these accounts, you're going to go down and bring over the balance, and if there is an adjustment, you're going to adjust it. So for cash, you're never going to have an adjusting entry that affects cash. Just remember that. They're only affecting assets other than cash, or liabilities, or revenues, or expenses. They're never affecting equity accounts, and they're never affecting cash. So cash you can just bring over, right? This 12,200, stays in the debit column, 12,200. But accounts receivable, we do have an adjustment, right? So accounts receivable started out at 1,000, right? And there's this, so it's a debit balance of 1,000, and it got a debit adjustment. So you add those, a debit plus a debit. So now we have 1,800 in the adjusted trial balance column. And you go down to the next one, office supplies. They start out at 500. Well, there's a credit of 400. So that's a debit, that's a credit you have to subtract, right? Because you got this debit, but you credit. So then you're going to have a balance of 100. And it's going to be a debit balance because you had more debit than credit. And you just do that all the way down. You bring if it's got an adjustment, you add or subtract, and you put it in its proper debit or credit column. And then at the bottom, you can find out, did your debits equal your credits? If these debits equaled your credits and these debits equal your credits, then of course these debits are going to equal your credits. But you gotta go through the steps to make sure. All right, so the rest of it we're going to use in chapter 4. All right, but start thinking about worksheets, start thinking about Excel, look at the Excel problem. We haven't done chapter 4 yet, so the last columns are really what we're going to get to in chapter 4, but start thinking about it. All right, so that ends chapter 3. So the next class is going to start chapter 4, so go ahead and finish up your chapter 3 homework. Be ready in class with questions over the video, and have a great day.